Is this the idea that essentially the pivot is dead? How have central banks, including the Fed, put themselves in a corner right now?
Well, thanks for having me on. Yeah, it's good to see you. That's exactly right. What surprised me the most is that it's taken the market this long to come around to this view, actually. I mean, we've been in this, when I say that the bad news, the good news was bad news, the problem is that the economy has just been, it's been quite strong, and it's very difficult to impact the economy with higher rates when people just don't need money as much. Everyone's refinanced, duration is longer. So it's just going to take a lot more. And we were nowhere near a pivot before. And when bad news is bad news, the rate side is about multiples for the most part and potentially credit. But then you've also got this earnings story. Earnings have been quite resilient. And as we get more bad news, that's going to really hit the earnings growth and the earnings growth potential, margins, et cetera. And there just isn't, there aren't a lot of good stories to find out here. And I think that we're, in a relative world, we've got to do our best. But U.S. dollar looks like the asset to hold right now.
Yeah, in fact, in your notes, you say that the U.S. dollar is your best friend at this point, which I guess makes everything worse, right? I mean, we heard how this could actually squeeze corporate profits as well.
Absolutely right. And it's also, as you intimated at the beginning of your question, it's also putting global central banks in the corner as well, because we're seeing what's happening. They have to sort of be in this match game here. They need to protect their currencies to some degree. They need to fight inflation. They need to not get behind the Fed, stop capital outflows, but they also need to protect growth. And that's an increasingly difficult thing to do. We thought the first country that would break would be an EM, an emerging market, when we saw a fiscal policy that was geared to protect growth. I am surprised. I think many were surprised. It was the UK. It was a sort of a developed market country that's sort of broken ranks a little bit with their central bank. But that is, I think it's a harbinger of what's to come. People expect it from EM, not as much from developed markets. And we'll see how long, sorry, some of these developed market fiscal, oftentimes populist governments can hold on here.
Dan, when it comes to the opportunities, obviously you're hitching to the strength of the dollar, but also what about the components of inflation that are likely to stay sticky? Do you look at opportunities in things like housing and energy?
Yeah, and look, I think the world has gotten just too negative on the energy complex right now. I get the argument that demand is slowing, that we're going to likely see some supply overhang for a bit, especially in a slowing world. But I think it's overdone. I think a lot of the oil production that's come to the surface now was sort of that pre-drilled oil, drilled but uncompleted wells that were being finished off. Exports from the strategic reserve from the U.S. U.S. exports really are way above historical norms right now. And this is an area where if we start to see some supply pullback, and actually a U.S. economy that is not as in dire straits as some may believe, we actually don't see a lot of bad news in the hard data. It's only expectational data that energy has the potential to actually rebound here. Energy companies still remain quite profitable, and we'll see what happens with margins, but I think it's just overdone. With housing, rates are not going to really reverse housing very easily. We've had some of the biggest rate corrections that we have seen in mortgages in decades, and the housing market still remains extremely strong. The amount of inventory that's being sold is historically very strong. It's just that inventory is very low. That plays right into owners' equivalent rents and the like in different CPI measures. So I think that areas like maybe Canada, Australia, they might see some softness in housing, which plays right into CPI. Countries like the U.S., housing in most areas will remain quite strong for a while.
You know, at this point, bonds, that pullback is almost about 25% from the top. And in fact, this year is likely to be probably the year to forget for anyone who's been managing money in bond markets to date. But take a look at this chart, which takes a look at 60-40. You know, so much for the return of this trade, right? At what point do we see this portfolio strategy coming back? Because for a while there, we were talking about bonds becoming relevant and useful again in a portfolio.
Yeah, I've been saying for some time that I thought bonds were the riskiest asset in multi-asset portfolios. That's just because earnings have actually held up, and there is some diversity in earnings within the stock portion. But rates were almost guaranteed across the board to move higher. And I think the danger here is that we think it's done. I think there is plenty of downside to go in the bond market. Now, there is some downside in the equity market as well. But equity earnings are they're a long way from crisis level collapse. We're just going to see some weakness coming along. So I still think that a lot of the fixed income and some of the credit will actually continue to be some of the bigger draws on portfolios here. And equities probably is the relative better choice, especially if you can find some inflation sensitivity, as well as some anti-cyclical growth like healthcare, as well as some of these consumer staples, dividend payers, really protected growth stories with global brand margin protection as well.
Daniel, good thing you mentioned crisis level collapses, because I want to ask you about where you are expecting to see that in the currency space. We have seen a lot of downside risk across Asian currencies, given the yuan getting past 7 and the Japanese yen with authorities intervening as well.
Yeah, this is a dollar story, right? So I think we need to be a little bit careful in thinking that there's overall weakness across the board. The yuan, I think, is getting close to its bottom. If the yuan tried to stay stronger against the dollar, it would be way too strong versus its trading partners. And I think that that's part of the issue here. They've got to manage to the trading basket. So the dollar, which is just the strongest thing out here, is sort of skewing what looks like maybe a bit more currency crisis in Asia. Now, we'll certainly, we'll certainly see, I think, more downside in some of the developed markets currencies, just because of the strength of the dollar too. I don't think the pound is done correcting. I don't think the euro is done correcting, and I think that the yen will stay weak, and they probably don't mind it being weak for some time as well, as Japan has become sort of a key cyclical exporter with favorable terms. So I don't know how else better to say it, but this is a dollar story and will remain a dollar story for some time.